Hello everyone, this is Professor Zhao at MTSU. First of all, I want you to look at the structure of the first module, and the first module is about portfolio theory. And this is your web page on D2L. As you see, all the learning materials are posted on D2L. And we have 4 modules to go through for the entire class. And each module has 3 different components. For example, in this first module, we have, in this first component, you have module overview, learning objectives, and keywords and concepts. And before you go through every individual chapters, I want you to look at those overviews, learning objectives, and keywords and concepts. For example, this is a first module's overview, and the first module we'll discuss the most important topic in modern finance, the risk and return trade-off for investors, which is covered in chapter 5. The diversification in chapter 6, and capital asset pricing model, as well as arbitrage pricing theory covered in chapter 7. So this overview will give you a big picture of what we are going to cover for the entire module. Now let's take a look at the learning objectives. And here we have 3 chapters to cover, and for example, in chapter 5, risk and return, we have 4 different objectives to achieve. First of all, after you complete this chapter, you should be able to compute different measure of returns on multiple years investments. And also you should be able to use the data on the past performance of stocks and bonds to conduct so-called scenario analysis to analyze the risk and return of a individual stock or individual portfolio. And the third objective for this chapter is to determine the expected rate of return and risk of portfolio that are constructed by combining risky assets with risk-free assets, and we call this as complete portfolio. And the last objective is to use the Sharpe ratio to evaluate investment performance of a portfolio given a certain capital allocation. So this learning objective will give you a detailed description on what you need to achieve after you complete every chapter. And this keyword and the concepts actually contains those key concepts, key mechanisms that you need to be familiar with before you go on to handle the homework and exam. And for example, in chapter 5, you need to be comfortable with the following terminologies, such as arithmetic and a geometric average, asset allocation, capital allocation line, capital market line, so on and so forth. If you have any problems, any issues with a given terminology, my advice is look into the textbook. And found that keyword in the index. Let's say now I'm not familiar with so-called Sharpe ratio, and I really wanted to know where I can find the detailed information about the Sharpe ratio. Well, in the index portion of your textbook, you look at all the terminologies. Start with capital word S, which is it's about the end of the textbook, and the textbook will show you that Sharpe ratio. Let me see. SH. Sharpe ratio. Sharpe ratio can be found in the following pages, 123 to 125, and also this terminology is discussed in other pages, 130, 136, so forth. So we go to page 123. And here we will get more information about the Sharpe ratio in terms of the definition of Sharpe ratio, how to calculate the Sharpe ratio, and the examples associated with the Sharpe ratio. So that is a pretty effective way for you to find detailed information in the textbook by looking at those keywords and concepts in a section called index at the end of the textbook. Okay, this module is about portfolio theory, and for the entire course we have 4 modules to go through, and I would say that the first module is the most challenging one because of its quantitative nature. But I will make things as easy as possible, and we have 3 chapters to cover. As you see, we have chapter 5, risk and return, chapter 6, efficient diversification, and chapter 7, capital asset pricing model and arbitrage pricing model. And all 3 chapters serve the goal of discussing the nature of modern portfolio theory. Right. So as a student, when you go through this online class, I want you to first of all look at the overview, learning objectives, and keywords and concepts for the entire module. Then spend some time, look at those chapters, PowerPoint slides, as well as videos. And at a certain time, you really want to read the textbook, and looking at the lecture notes and watch video, of course, is a necessary step for you to be familiar with the material. But the most important part here is read the textbook. All right. And once you feel you learned everything covered in each every chapters for a certain module, then it's time for you to go on, practice some questions, problems in the homework. And once you try a couple attempts in the homework, then you are pretty much ready for the exam. And both homework exams are in the assessment section of each every module. In addition to homework and exam, you also need to do the discussion. And here for the first module, the discussion is about introducing yourself. And I want you to write a short paragraph to describe who you are and introduce yourself to the class. And you probably want to start with your very basic background information in terms of your major. Are you a senior or junior? But more importantly, I want you to share your thoughts about your future career development and what do you want to get from this class. What is the expectation in this class? And if you have any strength or skills that you want to share with the class, feel free to do so. And this is also a mandatory part of your assignment for every module, the discussion. Right? Any questions, comments? Well, if you have any questions, comments, I want you to go to the discussion here. Right? And of course, you can post any problems, questions you have for every module. And we have specific topic for you to discuss for each module. But if you have any other issues, I want you to post here, online learning technical issues. Right? And sometimes you may have difficulty getting access to certain PowerPoint slides or get access to homework or exam, and any problem associated with technical issues in the D2L, I want you to post here. Now, it's time for us to be a little bit more serious, and let's start with a pretty easy chapter, chapter 5, risk and return. Risk and return. Well, let me ask you a question. What do you really care as an investor? Well, many of you would say, I want to make money, right? And in that case, you are very sensitive to the return aspect of an investment. But as a mature investor, you know that getting a certain amount of return is not that easy. And the higher the return, the higher the risk that you need to bear. And there's certain trade-off between return and risk. So in this context, you would say, hey, what's really matter for an investor is two things. First one is return, the other one is risk. But for a professionals working on Wall Street, he or she would say that the most important thing that they really care about is risk and return. Why is that? Well, for professionals, risk is the most important thing that they pay attention to. And they spend a lot of time evaluating the risk of individual securities, of their portfolios, and they try their best to handle risk and manage risk in a sophisticated way. And the return is just the natural consequence of managing risk and bearing risk for their security investments. So this chapter, risk and return, discuss the very fundamental mechanism of investment, which is the trade-off between risk and return. Remember, for professionals, risk is more important. Now, let's start with discussion on one of those two extremely important factors for an investor, risk and return. But we start with an easy one, the return. How do you describe the return of investment? A lot of people say, hey, I made $500 on my investment yesterday. I made $3,000 during the last month from my portfolio. Well, those descriptions are not very precise in terms of measuring the investment performance of your investments. And typically, you really want to introduce some percentage to see your relative investment performance, not in US dollars, but in percentages. And the most commonly used measure for rate of return is so-called holding period return. And holding period return measures percentage return of investments over a certain time period, typically over a year. And here, the equation show you that there's two different parts of your return. First one is capital gain, which is the difference between sales price and buy price. And if you buy low, sell high, you get certain amount of capital gain. But don't forget, you have another stream of investment income, which is cash flow. You can get from the security that you hold. As a stock, you may receive dividends. That's the cash flow that you are going to receive. If you're a bond holder, then the interest that you receive every quarter or every year would be the cash flow that you get from that investment. So you have two different types of income from your investment. One is cash flow income, the other one is capital gain. And then you put those gains together, divide that number with the purchasing price of the security, or PB, or the purchase price of the security that you're going to hold. And more often, frequently investors need to measure the rate of return over multiple time periods. They might hold security for 3 years, and let's say total returns 50%, but they want to measure the annual return of their investments. And every year they may have different number for returns, 20%, minus 5%, positive 10%, but what is the average return during that 3-year time period? Well, you would say it's very easy. Let's do the average. And average is a little tricky in finance. And we have two different types of average that you can utilize calculating investment return over multiple time periods. The first one is simple average or arithmetic mean. And here you simply put all the annual return together divided by a number of years. But arithmetic mean is not an accurate way of calculating investment return, because arithmetic mean or simple mean ignore the time value of money. A more precise way to calculate investment return is geometric mean. And the geometric mean take consideration of time value of money. Another issue regarding the rate of return is the difference between annualized rate of return and so-called effective annual rate of return. And APR, or annualized percentage return, actually is the nominal rate of interest or stated interest rate in a typical mortgage loan contract. But the effective annual rate could be different depending on your assumption of compounding. And if you assume that a compounding cycle is 1 year, then there's no difference. But it's very likely that a compounding cycle could be on a monthly basis, on a weekly basis, or on a daily basis. And the daily compounding is a common practice for American banks. And here you see the conversion between APR and EAR. I believe that you are very familiar with this mechanism when you finish your Finance 3010 class. Now, it's time for us to extend our view a little bit beyond return. Let's think about risk. So what is risk? Well, risk means you may lose money for your investments in the future. Well, everybody have good intention when they are making investment. Of course, they are expecting positive returns. Let's say 10%, 15%, 20, 30%. But you know what will happen in the future has great uncertainty. You may be able to make 30% for the next year, but it is also possible for you to lose money from your investment. Let's say the economy get into another recession and your investment may lose 10%. So in this case, there are multiple scenarios that you need to consider when you need to look into the future aspect of risk and return of your investments. So here I'm going to introduce a very useful tool for you to do so-called risk-return analysis. Many people do risk-return analysis based on what happened in the past, but from investors' perspective, the most important thing that you need to consider is what will happen in the future regarding risk and return. And the nature of risk requires you to look at many different potential scenarios. That's why we call this approach as scenario analysis. And we look at possible economic scenarios, and we know that stock market performance will be very different under those different circumstances. And also, we need to try our best to estimate the likelihood of every different scenarios. And then we look at expected returns on every different scenarios. Let's say economy is going to go through another recession. In that case, your expected return for your stock market investment would be, let's say, negative 10%. But if economy is in good shape, economy is booming, then you would expect that return would be, let's say, 15%, 20%. But here we need to consider multiple scenarios. Once we introduce different scenarios and make assumptions on different expected returns, then it's time for us to utilize some very simple tools that you learn in statistics. Standard deviation, variance, average, mean, and the essence of modern portfolio theory is called mean variance analysis. So what is mean? Mean is simply the average or expected return for your investments. What is the variance? Well, the variance measures the volatility of stock returns given different scenarios. So variance is a very, very useful term for you to capture the risky aspect of your investment. So mean variance analysis is about return and risk analysis. And the mean here is expected return, which measures the real return, and the variance is a measure of risk. And alternatively, investors love to use standard deviation to capture the risk aspect of investment. And the standard deviation is simply the square root of variance. Now, let's take a look at this table. And this table showed you the scenario analysis. Let's say we have 4 potential scenarios that you need to look at for the next 3 to 5 years. And in this case, it's just for next year. And the first scenario is severe recession. Second is moderate recession. Third was normal growth. And the last one is the boom of the economy. And based on your macroeconomic analysis, you would say, hey, it's very likely that economy will be on the right track. Let's say there are 40% of probability that economy will experience normal growth. And if this is the case, it's very likely that your investment return would be 14%. But you are pretty optimistic, and you believe that there's 30% of chance that economy will boom. In that case, your stock market return would be 30%. Right? While you are optimistic, generally speaking, but you are also very cautious, considering the potential possibility that economy can go south. And here, economy going south could be the case, but probability is much lower. Let's say you assign 25% probability for moderate recession and only 5% probability for severe recession. And under those two different circumstances, stock market returns not going to be pretty. If economy is in severe recession, it's very likely that your stock will lose about 37% of the value. If it's a moderate recession, your investment may lose 11%. So here we have probabilities and expected returns on the 4 different scenarios. And you know that in the future, there are many outcomes that you need to look at, but here you consider 4 different scenarios. And it's time for you to summarize all those different scenarios by using the expected rate of return calculation. And the expected rate of return of your investment simply equal to the weighted average return on the 4 different circumstances. And here in column D, you see we take a product of probability and holding period return for each scenario, and we add those numbers together, and we get 10% of expected rate of return. So this expected rate of return means that, okay, in the future, there are many different scenarios. If it's economic boom, you may earn 30%, but if economy going into another recession, then you may earn negative 37%, negative 11%. But on average, considering everything, all the possibilities, your average return is very likely around 10%. That is expected rate of return. Right? And once again, when you do expected rate of return, you are forecasting what will happen in the future for investment. You may say, for next year, my investment could deliver 10% return, 20% return, but the point estimation is not a comprehensive way for us to look into the risk-return trade-off for investment. A better approach is to look at different probabilities. Okay, it's very likely that return would be something around 10%, but keep in mind there is uncertainty, right? And uncertainty or risk can be measured by the variance. Measured by variance. And the variance is the sum of the squares of deviation from mean return for each different scenarios. For example, the deviation from mean return under the severe recession scenario is negative 47%. That's the difference between negative 37% and expected rate of return 10%. Right? And when you take a square of those numbers and put them together, you get so-called variance. When you take square root of variance, you get a standard deviation. Right? And this standard deviation is a very, very critical thing that you need to utilize to have a comprehensive picture on what will happen in the future for investment. And in this picture you see, okay, what will happen in the future follows a normal distribution, which means many things can happen. But it's very likely that your return will be something around 10%. And as you see, the probability around 10% is pretty high. And it's getting smaller and smaller on both ends. I mean, your return could be as high as 30%, 50%, 7%, but odds are declining. Of course, your return could be negative. Could be negative 20%, negative 50%, but odds are also diminishing. So this normal distribution is a very useful tool for you to look at the future risk return profile of your investment in a more comprehensive and reasonable way. So what we can say here is, well, the expected rate of return for investment is 10%, which is in the middle of this picture. But there's a chance. How big is the chance of that? Well, if you use a 95% confidence level, then you see that your rate of return would be something between positive and a negative 2 sigma. What is sigma? Sigma is standard deviation. Sigma is standard deviation. Recall that standard deviation that we got here is 18.63%, and here, let's say, we assume standard deviation 20% with expected rate of return of 10%. So this picture shows you that on the 95% confidence level, your investment return could range from negative 2 standard deviation to positive 2 standard deviation. And in terms of percentage return, it's something between negative 30% to 50%. Although you may have a chance to lose more than negative 30% or make more than 50%, but the odds are much, much smaller, less than 5%. Right? So on the 95% confidence level, what you can say here is, well, it's very likely that return would be something around 10%, but there's a chance you can make as high as 50%. How do you get a 50%? That is expected rate of return 10% plus 2 times sigma, or 2 times 20% plus 10%, that gives you 50%. Right. On the negative side, you may have chance to lose up to negative 30% of investment. How do you get that negative 30%? That is expected rate of return minus 2 times sigma. 10% minus 2 times 20%, which give you negative 30%. Right? So when you need to analyze the future risk return profile of your investment, it's very useful for you to utilize both expected rate of return and the standard deviation to have a more reasonable way or more comprehensive way to do the evaluation. Now, let's dig a little bit deeper into the risk and another very, very critical terminology called risk premium. Right? So what is risk? What is risk? Risk means uncertainty, and here we use standard deviation to measure risk. Right? And on the financial market, most assets are risky assets, but there is certain assets that we can view as risk-free, which means there's no risk. I think there's no risk. Quantitatively, the standard deviation would equal to 0. So that assets can be viewed as risk-free asset. And for risk-free asset, what kind of return can we get? Some people say zero because you bear zero risk, right? You're supposed to earn zero return, but actually that's not true. In the market, we can still find so-called risk-free assets. And those risk-free assets can generate small percentage of return, such as T-bills, right? Treasury bills. It's a risk-free asset, but T-bills also deliver a positive rate of return. And right now, it's something around 0.25%, and historically, that number can be as high as 5-6%. So the return on risk-free assets is called risk-free rate of return. That rate of return that can be earned with certainty, right? And with certainty means that the deviation is zero. What is risk premium? Well, if you want to earn higher than risk-free rate, then you have to bear more risk. Right? Why would you bear more risk? Well, answer would be very, very simple. The reason why you want to bear more risk because you wanted to earn higher return. Nobody likes risk, and there's a kind of risk aversion among all human beings. Risk aversion means human beings do not like risk. People hate uncertainty, and if there's no reward, nobody's gonna take any risk. So, from investor's perspective, unless one can earn actual return, also called a risk premium, nobody's going to bear risk. So risk premium is expected return in excess of that on risk-free security. That is reward that you can get as investor by bearing a higher amount of risk. What is the excess return? Excess return is rate of return in excess risk-free rate. So it looks like risk premium is pretty much the same as excess return, but the difference here is excess return reflect what happened in the past, and a risk premium is about what will happen in the future. Risk premium talk about how much return you can get by bearing a certain amount of risk in the future. But excess return simply shows what did you get during the past by bearing more risk. And the last terminology here is the price of risk. And the price of risk can be viewed as a simple measure of risk-return trade-off. It is the ratio of risk premium to variance. Well, what is variance? Variance is a very useful measure for risk. So here you have a ratio of risk premium to risk, or return to risk. That actually give you a very straightforward measure for risk-return trade-off, and we call this as price of risk. Right? Taking risk has price, and the investor needed to be compensated to bear more risk. And another measure of risk-return trade-off is called a Sharpe ratio. And the Sharpe ratio is also called reward to volatility ratio. It is the ratio of portfolio risk premium to standard deviation of the portfolio. Previously, price of risk is ratio of risk premium to variance. And here you see subtle difference. The Sharpe ratio is risk premium to standard deviation, alternative measure for risk. So overall, what we discussed so far and what we will discuss in future chapters regarding this modern portfolio theory is, simply put, mean variance analysis. Right? So what does it mean? The expected rate of return. What is variance? The measure of risk. And the mean variance analysis is simply risk-return trade-off analysis. And the portfolio theory handles risk-return trade-off analysis. Now, let's step back and look a little bit into what happened in the past in terms of risk-return trade-off for several different asset classes. And here we look into, let's say 1, 2, 3 different categories. The first one is the U.S. largest stocks. Second one is U.S. Small stocks, and the third one is U.S. Treasury bonds. This figure showed you the historical rate of return on stocks, bonds, and Treasury bills. What you see here is the history between 1926 to year 2010. That's virtually 90 years history on the financial markets in the United States. And the blue line here is the historical return for larger stocks, and the red one is for the long-term bonds, and the black one is for T-bills. And intuitively you would say, hey, this blue line go up and down like a crazy, right? And by saying crazy, you mean there's a great volatility, right? And for example, in 1930s, you see tremendous loss on the stock market. It's more than negative 40% loss in 1931-32. But stock market rebound in the following years, and the return on the stock market was higher than 40 or even 50%. Right? And this pattern continues. Not just happened during the Great Depression time period, it continues all the way towards the year 2010. And remember, during the most recent financial market collapse and economic recession, the market suffered from huge losses in year 2008 and in year 2010. Market was down by almost up to 40%. But the market also sharply rebounded in the following years. After year 2009, stock market rebounded, and you see stock market return was higher than 20% for year 2009. So that's nature for stock market, and you would say stock market is much more volatile. Now compare this to long-term bonds. You would say long-term bond also fluctuate, but the magnitude is much smaller, but not as small as the fluctuation that you can observe for T-bills. So from this picture, you would say, hey, definitely it's safe for you to say that a large stock is more volatile than the long-term bonds and more volatile than T-bills. Now let's talk a little bit more about return. Let's say you earn 20%, you earn 20% on your stock this year and 5% on your bond. So this is so-called nominal rate of return for your investment. And from a consumer's perspective, you would say nominal return may not be the real return. Why is that? Because money may lose its value through inflation. What is inflation? Inflation means prices are going up for everything. Things are getting more expensive, right? Does that mean things are getting more valuable? Well, it's not. Just that the prices are higher, right? And it's the same thing, just with a higher price. In that case, we say that inflation is in the positive territory, and your money is losing value. So things are getting more expensive, your money is losing value. So from investors' perspective, let's say you earn 5% for your bond investment. Is that your true rate of return? Well, probably not. If the inflation rate is 2%, well, you know that your true rate of return would be 5% minus 2%, about 3%. Right? So from investors' perspective, you always need to pay attention to inflation because inflation will eat up your purchasing power of your money and reduce your real rate of return. So here, based on a very famous equation called Fisher equation, the nominal rate of return equals inflation rate and the expected rate of return for your the real rate of return. The real rate of return and the expected inflation. Right? So R here is nominal return, ER is expected inflation, and this R is your real rate of return. And the inflation is always there. Not just for this year or for next couple of years. I mean, it's been there for more than 100 years, and it will continue to be the case for the next 100 years. And in this picture, you see the movement of three different types of things. First one is inflation, which is described in this red line. And also you see the trend for T-bill, Treasury bills. And the black line is real rate of return for T-bills. Right. Let's say you are a Treasury bill investor and you earn 5% in certain year, but given 5% inflation, then your real rate of return would be 0. So this real T-bill showed you the real rate of return by holding Treasury bills over the last 90 years also. And as you see, your real rate of return on T-bill could be negative if economy experience high inflation rate. And in certain years, you see there is inverse relation between inflation rate and real rate of return on T-bills. That's very obvious during 1930s, 1940s, and the 1950s. And during 1970s and 1980s, you found a very similar pattern. Just that the difference between T-bill and real rate of T-bill are diminishing because in most recent years, inflation rates are much lower, lower than 5%. And based on statistics, during the last 100 years, the average inflation rate in the United States is about 2.5%. So the implication here for investor is that for the future, let's say for the future 20, 30 years, you probably want to consider, let's say, something between 2 to 3% inflation rate when you need to do any decent risk-return trade-off analysis. All right, let's take a short break and we will continue our discussion.